Money Monday is sponsored by Husky Financial.
The demand for home mortgages jumped 8% last week compared to the week before, despite an increase in mortgage interest rates. But home sales are generally down, with prices expected to follow next year. Well, that's just part of the story. Here to share more on what's happening with our economy is David Monckton, certified financial planner and advisor for Carolina's Wealth Management. Welcome back.
Thank you very much. Glad to be here.
So kind of unpacked a lot of stuff right there. A lot of people, let's start with what really truly matters to a lot of people, and that is home buying.
Right.
And us being in a super hot market, we are starting to see an uptick in mortgage applications. But to what extent? What's the distinction there and why?
Well, let me back up a little bit. Let's talk about mortgage rates in general. You know, when we got into this year, 30-year mortgages were less than 3%. They've more than doubled. They were 6.3 last week, and that is certainly having an impact on home buyers. You know, we've still seen our home prices go up. But back to your question, I think the uptick in applications is twofold. There's the concern that people feel like rates are going to continue to go up, so they need to lock in now. You've got people that have adjustable rates that may have lower rates than they're going to lock into, but they're scared of what their rates may be 2 and 3 and 4 years from now. So we're seeing a little bit of urgency on home owners and home buyers to lock in rates that they feel are going to go higher in the future.
And what I'm understanding is these are adjustable rates. So they want to get in on that adjustable rate and then hopefully down the line refinance.
Right. Which yeah, it's good to have a plan. Everybody needs to have a plan, but adjustable rates, you need to understand if you're getting something below what seems to be market rate, there's a risk to it.
Well, we remember what happened in 2008 maybe?
Right.
Yeah.
Right. And a lot of the reason we had the housing crisis is those adjustable rates, really low rates. We had the crisis, then they reset higher and people couldn't afford their mortgages.
Like, oh yeah. Remember that mortgage that we took out some years ago?
Here's my keys, I'm going to leave
now.
Exactly.
So when we're talking about the Fed making money basically more expensive, what is the reason why they're doing this, and how is that supposed to help us in the long term?
And that's the big issue they're dealing with right now. The biggest fear for our economy is inflation. You know, for 20 years, it's been running at 1 to 1.5%. We're seeing prints this year of 8, almost 9% inflation. They can't have that. The Fed's #1 goal is to keep inflation around the 2% range in full employment. Well, when we have inflation running at 8, 9%, it's not sustainable. So they're doing everything they can to try to tamp that down. And think of inflation as supply and demand. You mentioned real estate. You know, if we've got a wonderful neighborhood here in Charleston and there's not many homes for sale and a lot of people want to buy it, then the prices go up. Well, the Fed can't control the supply side. They can control the demand. Well, if there aren't that many buyers, but they raise interest rates and refinancing or financing mortgages cost more and more and more, it's going to tamp down that demand. So while we wait for what's going on in Eastern Europe and while we wait for the supply chain to normalize, the only thing the Fed can do is raise rates to try to slow the economy down somewhat.
And this is all to avoid a recession, which in fact we kind of think we're in one.
Yeah, and, you know, it's dancing on the tip of a pen, if you will, what Jerome Powell, the chairman Fed's having to do. He wants to slow things down, but does not want to go into a recession. But even if we do go into a recession, the Fed views that as a better medicine than continued high inflation. Anecdotally, I picked my daughter up from school 2 weeks ago, the last day of school, went and filled the car up, went to the grocery store, didn't get that much, I thought, from the store, and it was a little over $400. Well, everybody in America is having to do that. And if we're putting more money into food and energy, that's less money to go see the new Top Gun or go to Target or Walmart or whatever the case may be. So
all the fun things.
The fun things. So that slows the economy down as well. So the Fed's #1 goal and fear is inflation running to the degree it is now. Their projections based on what they're doing with interest rates, they're going to raise them again next month. They plan to raise them every month at every meeting the rest of the year. But they feel like by doing so, they'll get inflation back to the 2.5% range by the end of next year.
By the end of next year. So we're not looking at, when we hear the word recession, of course, that incites a lot of fear amongst people who have long memories that go back. into the 90s and before that even, but we're looking at something that's maybe a little bit softer, not quite as dire.
We hope. No one can predict the future, but the Fed feels like they can afford to raise rates and throw us into hopefully not a recession, but a light recession or a shallow one, and then we can move forward. But we just can't move forward with as frothy as the economy's gotten, whether that's from organic growth or a combination of that plus supply issues, and as we mentioned, the horrible situation going over in Ukraine.
Yeah, exactly. And finally, as a financial advisor, we didn't even get into portfolios. We kind of ran out of time for that, but just as a financial advisor, what is your advice for people watching this?
My advice is, if you're concerned about what's going on in your portfolio, which most people are, we didn't talk a lot about markets, but they're obviously down this year. As of today, they're down over, the stock market's down over 20%. Yeah. And everybody should have bonds in their portfolio. They're the ballast, if you will, that allow us to own stocks. Well, the tough part about this year is bonds are down by the Barclays Aggregate Bond Index. They're down over 11%. So both stocks and bonds are down in value. And what we tell people, we're telling our clients, don't have a knee-jerk reaction. Number one, you should always have a plan for the long term. Sure. We understand markets don't stair-step upwards. They're going to be volatile. But if we've allocated ourselves properly and we understand markets are going to be volatile, then we can weather these times. It's people that make the wrong decision at the wrong time that end up getting hurt when we're going through these episodes.
That's why we rely on smart people like you. Thank you so much. Appreciate your time.
Appreciate it.
We're back after this.
Money Monday is sponsored by Husky Financial.